It is a pleasure to be joined by Mark Brennan, CEO of Cerrado Gold, an emerging mid-tier, low-cost gold producer with core assets in South America. The company today announced very favorable feasibility study results of their Monte de Carmo project in Brazil. Here at Grizzle, we're investors in Cerrado Gold through our DARP ETF, and we're excited to discuss with Mark the key details and takeaways from this important release. Mark, thank you very much for joining us.
Thank you very much for having me, and thank you very much for being engaged in the story.
Thank you.
So, Mark, I wanted to get right into it. The economics on Monte de Carmo continue to impress us. Now, for anyone who isn't familiar with the project, could you just tell them what the key findings were from your point of view from today's feasibility study?
I think that what the feasibility demonstrates very clearly is for producing assets or potential producing assets sub 100,000 or around that 100,000 mark. This, if not a best of breed, is certainly a very, very high quality asset. You're looking at an all-in cost of $715. So very low cost, capex of 190 million, including our fleet that we didn't have in the PEA. So from that perspective, it's a fairly straightforward project. Very, very high returns over a 9-year period, payback in just over 2 years. It really is a very, very strong project, and that's what's really strong and solid. So that's what's highlighted to me in this feasibility study.
Got it. Now, for us, two of the most important takeaways were the low cost. So it looks like you're going to be comfortably in the kind of first quartile at 700 or change AISC, and then also significant free cash flow on an annual basis. So I'm just wondering, what are the main drivers making this one of the lowest cost gold projects out there? I mean, is it simply the grades are that good? Is it the access to infrastructure? Can you kind of take us through the drivers there?
Well, I think it's all of the above. I think one, you have, first of all, Brazil, the real at 5 to 1 is a very attractive currency unit at this point, converted to US dollars for the return. But on top of that, as you say, infrastructure is amazing at Monte de Carmo. The ore is very clean. It's very process friendly. So we have low processing costs. In terms of the just all aspects of this project are very, very advantageous.
Great. Now, Monte de Carmo, I'm going to call it MDC from now on for short. Now, it based on this report, it's going to throw off 2 times your market cap, your current market cap, in free cash flow every year, which is a little crazy. But you're obviously not getting credit with the significant stock discount to NAV that we see. So I'm wondering, what are the investor pushbacks you're hearing, if any, right now?
To be honest with you, I haven't had too much pushback. I mean, people are questioning. First of all, we've got a first-rate engineering firm, DRA, who are amongst the best engineering firms in the world. They actually build mines, just not report. They don't just do reports. So from that perspective, I think the quality of the work done in this feasibility was very, very strong, and I don't think there are any holes in it. I think you look at the resource, and we've had 2 or 3 engineering firms confirming kind of the resource to us, and so everything we look at here is pretty solid. It's not a big project. It's a very simple project in a wonderful jurisdiction, strong support of the local community. We haven't had a lot of pushback. I mean, frankly, what we really see more than anything is just apathy, investor apathy.
So more macro, you'd say it's kind of what we've seen across the malaise that we've seen across in the small mid cap space in mining across the board, right? We need that kind of next leg up in the core commodity prices just to really get bring the animal spirits back.
I think so. It's a difficult time right now for many companies, right?
Yeah. But at least we'll get to the funding, but funding is not one of your issues. So well, let's talk about that for sure. Now, I just wanted to talk a little bit about the gold price that's underpinning this report. You're using about $1,750. Just curious, kind of what went into that number. I think that's a pretty good conservative number. We're obviously higher than that, but just curious what the drivers of that number are.
Basically, what the engineers in particular did, and what was determined, was to use basically a compendium of new recent feasibility reports that have come out, and kind of find an average price on those, which is where we kind of came in. And so we've seen higher, we've seen lower, but again, $200 below current spot prices, pretty conservative.
Got it. And as I understand it, you guys put a helpful sensitivity table in the report that you put out. The project is not that sensitive to gold prices, and that's a function of the low costs, right?
The
I
low
mean, it's
costs.
it's gonna make a good amount of money even if prices are lower than that or higher.
Yeah,
Than that.
it doesn't. You know, if we're $200 or $300 below the gold price today, it doesn't change, or even the 1700. Excuse me, it doesn't change the metrics dramatically. It's a highly profitable mine, no matter how you cut it.
Okay.
And that's one thing I'll just add, Scott, if you don't mind. You know, this is a 100,000 ounce producer, but it's generating profit and cash flows that are very similar to mines that are much bigger than it. You know, 150, 175,000 ounce producers. Or that's the expectation according to the report. So, you know, I think that's something to really bear in mind. It's not all about quantity. It's really all about, you know, quality and then cash flow.
Got it. Now, so even though the economics of the project are still best in class from your prior study in 2021, I just wanted to hear from you, what were the moving parts that drove the decrease in the net present value compared to the PEA?
There was one major driving point, and that was the resource. And so what happened in when we did our PEA, we did the resource according to the all the standards, the regulatory standards, ICM standards, and basically, but our drilling spacing was at 60 meters, and when we brought in, you know, the meterage to say distances of spacing of say 15 to 20 meters, we lost a fairly significant chunk of our high grade, very near surface ore, and that was probably close to about 150,000 ounces of maybe 2 gram material. So that hurt us a lot, to be honest with you. It was scientific. I mean, you know, from the PA to the feasibility study, we complied with all the rules, and so there was no way you could have foreseen that when you had the 60-meter spacing. We just saw the continuity according to the regulations. When you're 60-meter spacing under a PA, that's permissible. Under a feasibility, that's not, for the very reason why that we lost it. Our kind of hope is that we haven't lost it entirely, but at the same point, it really has had a significant impact in terms of the numbers.
Okay, that's good to understand. Now, I want to talk about the resource. I love talking to you about these kind of bigger picture trends because you have like a distinguished career in the industry. You've been through building mines. You've seen how cycles move. So you built projects before, and you know how resource estimates can change significantly and grow over time. I know there's a good slide in your deck on that. Now, is there still exploration potential at MDC as you develop the asset? I mean, this isn't a static resource, so it's not. This is what it is, right?
And I'll emphasize, we have 82,000 hectares, and the 1.1 the reserve that we have. It basically comes in for the measured indicated resource, of 1.1 million ounces, basically comes from less than 1,000 hectares. So the reality is that we've done some journaling off site, but that really has not been the focus of the company since we started the development process. Really, the focus of the company has been bringing us to where we are today, where we can bring the mine into production and use the production capital to go and do significant exploration.
Gotcha. Yeah, you guys are all about the return potential, right? And time is a big factor of that. So instead of spending an extra 5 years on exploration, if you have a project with economics like this, why would you not produce it, right?
Yeah, agreed. And again, I think any funding that we look at, or the fundings that we are looking at, has a component where we can come in and drill significantly with the funding, which would really help us in terms of timing.
Now, I wanted to move on to funding, actually. I know you've had no problem lining up project financing. You just announced that you had a bunch of bidders for your financing for this project and for up in Canada. So I wanted to ask specifically about something I noticed, where the upfront capital now for MDC is about $187 million if you use the contingency. Now, I noticed the UK Export Finance Agency, which is going to help the debt component for this project, said they'd be willing to fund up to 190. So it's similar numbers. Obviously, they're not going to use 100% debt. Does that just tell me that you have a lot of flexibility in your funding, basically?
Yeah, and there's a lot more access to capital from their funding. They'll fund on a 70-30 debt to equity ratio. And so basically, they'll fund up to 70% of the capital requirement into their program. And so, I think at 190 million, that would mean our capital program would be somewhere close to probably 280 or someone 285 or something to that effect. So the reality is that, there's lots more capacity for funding than what we'll actually use.
Got it. Okay, that's helpful to understand.
And Mark, could you remind the audience just the structurally low cost of this type of funding?
Yeah, I mean, we're using export credit agency funding, and we would anticipate that our total cost of funding will be less than 7% with a long-term note, which has a lot of advantages as well, right? So it's a very, very attractive form of capital, and it's very friendly capital, which is good. And also, as I mentioned, I mean, there's plenty of capacity for future expenditures and growth of the project.
Great.
Now, Mark, I'll tell you one of the things that we like best about how you run the company is that you have a long-term vision. It's not just look at how many ounces I found. Maybe I'll produce them someday. You're saying, okay, I have this project I like. Now, what's next? There's another project I may like. So what I like is that you have a credible plan to use the free cash flow from Brazil to continue growing Cerrado as a company. Now, I wanted to ask, are you still confident that the free cash flow from Brazil can fund the lion's share of the startup costs at your even larger and still low-cost Monte iron and vanadium project in Canada?
Yeah, unequivocally. I think in terms of if you look at Monte, my guess is that probably doesn't come to construction, at the earliest, probably to sometime in 26, 27. And at that point, we're generating, at today's prices, probably somewhere close to, $120 million a year. And from that perspective, where we are is in a position that we can use excess cash flow. If we have the UK Export Credit Agency, UCAF, funding us 70% of debt on that project as well. So at a 600 million capex, basically that means 420 million will be looked after through project debt, project finance, and then therefore we have about 180 million to catch up with. I think it'd be very easy on this project that it'd generate $350 million a year of cash flow to throw a stream on for 100 million, which would mean somewhere around 80 million of equity requirement that I think we could easily fund out of Brazil.
Got it. That's helpful to put some numbers around that. Mark, so just to round things up, can you kind of leave us with what the next catalysts are for Cerrado that us and everyone watching should be looking for?
Well, I think what we'll see in the near term is we should see the announcement of our mandated lead arranger for the funding that we're working with the UK government. Subsequent to that, we should see the construction license coming from the Brazil government. And then from there, hopefully we're looking to close off the funding, by second quarter of next year.
Okay, great. Well, exciting times for you guys. Congratulations, and we'll definitely look forward to following all the exciting things to come at Cerrado.
Thank you very much, and as are we.
Yeah, well, thanks, Mark. We're excited to, obviously, we're long-term shareholders, and we're excited to see this get developed. And just as a reminder for the audience, this is the Monte Carmo project in Brazil, an MPV of 400 million, IRR 34%. This is one of the lowest cost gold projects in the world, with an all-in sustaining cost of $711 per ounce. That's quite remarkable, Mark. And hopefully, here's to a much higher gold price.
Absolutely.
Thank you, Mark.